Welcome to Informed Investor. Tata Motors, a favorite stock among investors, has recently faced a rough patch. Over the past 5 days, its shares have declined around 8% and over the past year, they have fallen by about 31%. A combination of global tariff tensions and recent revisions in its financial forecast from its core subsidiary Jaguar Land Rover has added to investor concerns. So stay tuned as we unpack the details behind Tata Motors' current situation and what lies ahead. Now to start off, Tata Motors is a leading global automobile manufacturer and a prominent part of the Tata Group, one of India's most respected multinational conglomerates. Founded back in 1945 as a locomotive manufacturer, the company has evolved dramatically over the decades to become one of India's most respected automotive brands. Today, the company holds the position of India's market leader in commercial vehicles and ranks among top 3 in the passenger vehicle market. Another interesting point is that Tata Motors' reach extends far beyond Indian shores. In 2008, the company made a bold move by acquiring the British luxury car manufacturer Jaguar Land Rover from Ford. This acquisition transformed Tata Motors from a regional player into a global automotive force with a presence across multiple segments, from budget-friendly hatchbacks to ultra-luxury SUVs. Currently, Tata Motors have a product portfolio offering commercial vehicles, passenger vehicles, luxury vehicles, which is a Jaguar Land Rover business, and recently forayed into the electric vehicles. Apart from these, they also operate in vehicle financing business referred to as Tata Motors Finance. Now, when we look at Tata Motors' financial structure, one thing becomes immediately clear. JLR isn't just a subsidiary, it's the backbone of the company's financial performance. Jaguar Land Rover leads with 71% of total revenue, followed by commercial vehicles at 18% and passenger vehicles at 10.5%. Corporate, unallocable and vehicle financing contribute marginally at 0.12% and 0.01% respectively. Speaking about JLR in detail, for the financial year 2025, JLR contributed a whopping 71% of Tata Motors' total consolidated revenue. Even more significantly, it accounted for approximately 80% of the company's overall profitability. These numbers highlight just how dependent Tata Motors has become on its luxury vehicle division. The average revenue per JLR unit stands at impressively around £70,000, around 81.8 lakh rupees, which explains how this division generates such a significant portion of the company's income despite selling fewer vehicles than the Indian operations. JLR's premium positioning allows it to command higher margins than Tata's other divisions. In FY25, JLR achieved an EBIT margin of 8.5%, significantly higher than the margins in the commercial and passenger vehicle segments in India. This heavy dependence on JLR means that any fluctuation in JLR's performance has an outsized impact on Tata Motors' overall financial health and stock price. That's precisely why the recent announcements about JLR's revised forecast have sent Tata Motors shares into a decline. So what's behind this sudden recent decline in Tata Motors stock price? Let's break down the key factors that have investors concerned. In a recent investor presentation, JLR lowered its earnings before interest and tax margin forecast for FY26 to just 5 to 7%, down significantly from the previously expected 10%. This is also lower than the 8.5% margin JLR reported in FY25. A mix of factors are contributing to this. Geopolitical tensions and tariffs, regulatory changes, EV demand and contraction in China are contributing to this. JLR management has stated that they aim to improve cash flow in FY27 and FY28 with a target to eventually restore EBIT margins to 10%. However, they haven't provided a specific timeline for achieving this goal, which has created uncertainty among investors. Perhaps even more alarming than the margin reduction is JLR's projection for free cash flow. After reporting a robust free cash flow of 1.5 billion euros in FY25, JLR now expects this figure to be close to zero in FY26. The near zero cash flow projection is particularly concerning because it limits JLR's ability to invest in new technologies and products without taking on additional debt. The imposition of a 25% US import tariff on foreign-made vehicles has significantly impacted JLR's profitability, as the US accounts for approximately 30% of JLR's global sales. In response to these tariffs, JLR temporarily paused vehicle shipments from the UK to the US in April 2025 to reassess its pricing strategies and work out new trading terms with its business partners. However, there's been a recent positive development. On Monday, US President Donald Trump and UK Prime Minister Keir Starmer signed an agreement that provides some relief. The deal gives British car maker an annual quota of 1 lakh vehicles that can be exported to the US at a reduced 10% tariff rate compared to the 25% rate faced by other countries. While this agreement offers some breathing room, it still represents an increase from the previous tariff rates and will continue to pressure JLR's margin in the US market. Lastly, China, the world's largest automotive market, presents another significant challenge for JLR. Despite outperforming the broader market, JLR is facing mounting pressure in the premium car segment. The company has cited several concerning trends in the Chinese market, with an expected 15% contraction in the premium market for FY25, along with a sharp drop in new credit issuance and a wave of dealership terminations. These challenges in China are particularly significant because it's one of JLR's key markets for growth and profitability. Now, in Q4 FY25, Tata Motors reported a consolidated net profit decline of 51% to Rs 8,556 crore, with revenue from operations at 1.19 lakh crore. Operating profit for the quarter fell 4% year-on-year, and EBITDA margins decreased by 60 basis points to 14%. The sharp decline in net profit might seem alarming, but it's worth noting that Q4 FY24 included a one-time gain of 9,538 crore from deferred taxes, which inflated the previous year's profit figure. Excluding this one-time item, the profit performance was relatively stable. Notably, Tata Motors auto business is now debt-free, which has helped reduce interest costs and reflects healthy business fundamentals despite the profit decline. Now, despite these challenges faced in FY25, JLR maintained its number one position in the premium segment in May and outperformed the broader market. However, risks remain, including semiconductor shortages, supply chain disruptions, and the complex transition to battery electric vehicles. Adapting to evolving regulations and consumer demands will require strategic agility. For FY26, JLR aims to stabilize its financials through its reimagined transformation initiative, expected to generate £1.4 billion in annual benefits, supporting improved margins and cash flow in the medium term. In the Indian market, Tata Motors has ambitious plans to regain a 50% market share in the EV passenger vehicle segment within the next 18 to 24 months. The company plans to launch new EV models such as Harrier EV, Sierra EV, and Curve EV, aiming to strengthen its presence across various price segments, including the premium EV space. Additionally, Tata Motors is focusing on expanding its commercial vehicle business, targeting a 40% market share by FY27. The near-term outlook includes navigating global economic uncertainties, supply chain challenges, and the ongoing EV transition. Tata Motors is currently facing headwinds primarily due to challenges at JLR, including reduced EBIT margin guidance, near-zero free cash flow expectations, and tariff-related profitability pressures. Despite these issues, Tata Motors remains strategically focused on growth, particularly in the EV segment in India and premium vehicles globally through JLR. The company's debt-free status and ongoing operational efficiency initiatives provide a solid foundation for recovery. Investors should approach Tata Motors with cautious optimism, recognizing the near-term volatility, but also the long-term potential driven by innovation, market leadership, and strategic transformation. The recent tariff relief from the UK-US trade deal offers some respite, but macroeconomic and geopolitical uncertainties continue to pose risks. In summary, Tata Motors stands at crossroads, grappling with short-term challenges but equipped with strong strategic vision for the future. For investors and auto enthusiasts alike, the coming years will be critical in witnessing how Tata Motors and JLR navigate this complex landscape to emerge stronger. Now, moving on to some other important market updates. Shares of Vishal Mega Mart fell 7% today after a massive 10,488 crore block deal. Around 93.6 crore shares, about 20% equity, changed hands at an average price of 115 rupees. The deal comes right after the shareholder lock-in period ended. Promoter Samayat Services, backed by Partners Group and Kedara Capital, was expected to sell up to 10% stake. Secondly, Zee Entertainment will raise 2,237 crore by issuing 16.95 crore convertible warrants to promoter group entities at 132 per warrant. This move will increase promoter shareholding from 4% to 18.4% subject to shareholder approval. The company said the fund infusion will help strengthen its core business and financial position for future growth. An upfront payment of 33 per warrant will be made with full conversion allowed within 18 months. Next, Biocon has launched a 4,500 crore qualified institutional placement to issue up to 139 million shares, or 11.6% of its current equity base, at a floor price of 323.2 per share. Proceeds will be used to repay debt, invest in biologics, and meet general corporate needs. This issuance price will be finalized later this week. Moving on, shares of HDFC Bank rose nearly 1% after reports confirmed that its subsidiary HDB Financial Services plans to launch its 12,500 crore IPO between June 25 to 27. The issue includes a 2,500 crore fresh issue and a 10,000 crore offer for sale by HDFC Bank. The company is targeting a post-money valuation of 7.2 billion, approximately 62,000 crore. The listing fulfills RBI's mandate for upper layer NBFCs to go public by September 2025. Now, having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.